Hello everyone, welcome to this video. Today, we will see how managers and business owners can evaluate new investment opportunities. A company, in order to remain profitable and keep growing, must constantly reinvent itself. That means investing today to generate profits tomorrow. Economically speaking, a dollar today is not worth the same as a dollar in the future. Moving money back and forth over time is fundamental to understand the value of an investment. For example, if we invest a dollar today, with an interest rate of 8% per year, we can calculate its future value in 1 year, which is $1.08. It is indifferent for us to choose between the right to receive a dollar now or the right to receive $1.08 in 1 year. We can also follow the opposite approach and calculate the present value. If we are offered $1 to be received a year from now, with an interest rate of 8%, the equivalent current value today is 93 cents. The interest rate is also called discount rate. The higher the risk of the investment, the higher the discount rate. The present value is an important tool to assess new investment opportunities in terms of cash flows. We talk about discounted cash flows analysis. Our investment valuation process can follow 3 basic steps. Step 1, we create a cash flows timeline. Step 2, we select the appropriate discount rate. This should be the rate we can earn on investments of equivalent risk. Step 3, we sum up the cash flows present values for each period. Let's see an example. We invest $10,000 in solar panels, and we expect to save $10,500 on our electric bill in 1 year. The net benefit related to this investment is $500. But let's see if this is a good return or not. We follow the 3 basic steps earlier discussed. Step 1, we create the cash flows timeline. Step 2, we select the discount rate, for instance 8%. Step 3, we calculate the present values for each period. In other words, if we invest $10,000 today to install solar panels, after 1 year we get a net benefit of $500. However, if we compare this investment with other investments carrying a similar risk, we get a negative return. It would be much better for us to take the $10,000 and invest them in another project on the market with a return rate of 8%. Let's change a bit our example and consider an expected annual benefit of $5,500 for 2 years. We calculate the present value for year 1 and year 2, we then sum up the amounts, and eventually we get a negative result of $192. The return of the investment improved, but it is still better for us to invest the $10,000 in another opportunity with similar risk. Now, let's imagine to have an annual benefit of $2,800 for 5 years. We follow the same steps, and finally, we get a positive return. In other words, with a discount rate of 8% and an annual benefit of $2,800 for 5 years, our investment opportunity is better than other opportunities carrying similar risks, that is exactly $1,181 more profitable. A common mistake when working on a discounted cash flow analysis is to forget to include inflation. If we don't consider inflation, we understate significantly the present value of the investment's cash flows. Looking at our last example, suppose electricity prices go up by 5% per year. We adjust our expected benefits and the related present value as reported on the slide. What we see is that inflation has a positive impact on our present values. We update our table with the new calculated values. Our final return went up to $2,392. One of the biggest challenges in the discounted cash flows analysis is that forecasts and assumptions are often inflated. That's because of our natural optimism and bias. It is recommended to split the analysis, considering 3 alternatives: best case scenario, worst case scenario, and something in the middle, most probable scenario. The key factor is to assess the cash flows timing with the highest level of accuracy possible, avoiding emotions and biases. That's all for today. Hope you enjoyed the video. Please, do not forget to subscribe.